Hello everyone, I hope you all are doing great. Today I'm going to be starting on subsequent measurement of assets under IAS 16. So in this session we will be discussing that once the entity recognizes the asset under IAS 16 in initial recognition criteria, then subsequently how does a company hold those assets till their useful life ends. So IAS 16 basically gives a choice to the entity to choose one of two models for measuring its property, plant, and equipment. So, the first model is known as the cost model. Under cost model, the asset is going to be carried at its cost, which is the initial cost, okay, at which the asset is recognized, less, so you will deduct the accumulated depreciation, for which it means the total depreciation on the asset, and impairment loss. Because we have not discussed impairment loss yet, you can simply take impairment as something that also reduces the value of the asset. But the difference between depreciation and impairment is that depreciation reflects the wear and tear of the asset, whereas impairment is the deduction in the asset's value for completely different reasons. And don't worry, we'll be discussing this standard in the future. But just know that cost model is simply the cost less accumulated depreciation and impairment loss. Using this, we will get the carrying value of the asset at that specific time period. And as we all know, depreciation begins when the asset is ready for use, not when it is actually used. This is something that I had discussed in detail in my depreciation video. So if you want to check it out for a quick revision, make sure you do that now. But depreciation should be charged when the asset is ready for use. Moving on, we have another model that IAS 16 allows, which is a revaluation model. Under revaluation model, what we do is we adjust the carrying amount of a non-current asset to reflect its fair value as of the revaluation date. Revaluation date is simply the date at which the entity decides that we are going to revalue. So it's that date particularly at which you will update the value of your non-current asset to the fair value. So you take the carrying value, all right, and you adjust it to the fair value of the asset as of revaluation date. Under IAS 16, if an entity applies the revaluation model, assets are revalued at fair value at date of revaluation, with subsequent revaluations made regularly to ensure the carrying amount does not differ materially from the fair value. So basically it means that once we do that, IAS 16 tells you that you have to make regular updates to the value of the asset to its fair value. It is not one-time revaluation, all right? So if I decide that if I want to revalue the asset today to its fair value, it is not one-time revaluation. I have to update my asset to the fair value on regular basis. So this is what revaluation is, where the asset is going to be carried at its fair value. So why a company might decide to revalue? You might wonder, why would a company prefer revaluation model over cost model? Number one, we have true and fair representation of the asset in that way, because the assets would now be represented at their fair value. So they would be representative of their current up-to-date market value rather than outdated historical cost. So if we have higher asset values due to revaluation, this can improve the borrowing capacity as stronger assets act as better collateral. So you will have more security to provide over the loans that you borrow, and therefore this will increase the confidence of the loan providers to give you higher loans. All right, and this can also improve the conditions of the loan for you. However, a higher asset base can reduce the return on the assets. Return on asset is simply net income divided by total assets. So if you have a high total base, this can reduce your return on assets, and sometimes management might not prefer this if they're looking to improve short-term performance measures. So they might feel like, I don't want to revalue the assets because it's going to reduce my ROA. But it all depends on the company after all. Then we have market conditions. If an asset's value significantly appreciates, example in a booming market, a revaluation prevents undervaluation. It simply ties true and fair representation, as we have discussed in the first point, is that if the market is going to be fluctuating for that particular asset, then if you adopt the revaluation model, your assets will be reflecting the current market situation and therefore will be representing more true and fair view of your overall financial statements. All right, so that is what we mean. And then planned disposal. If a company intends to sell an asset, revaluing it before disposal ensures the carrying amount aligns with market value, reducing sudden gains or losses on the disposal. So basically, it means that you'll be more aware of the gains and losses that you can expect on the disposal. However, there's an important point that I want to mention. If the carrying value is close to the market value and you're going to sell the asset at the market value, then this can reduce the profit that you can make on that particular asset. All right, so sometimes what happens, a company might not look forward to the revaluation model if their overall profits on disposals are going to go down. So sometimes they would prefer the cost model because the carrying value of the asset under cost model is a lot going to be lower than the carrying value under revaluation model. So they would prefer to go for the cost model to increase the profits on disposals. So that's one thing. But the advantage of disposals under revaluation is that you will have a more predicting nature of the gains and the losses that you can make on disposal. All right, don't worry about these things right now on how we can have higher gains or losses under cost model and how it is different from the revaluation, because we'll be discussing disposals in detail in future videos, and along with calculations we will also understand how a company can have different profits or losses under both models. All right, so this is just to gain an overall idea about revaluation model. Now, how is revaluation calculated? Revaluation is determined by comparing the carrying value, which is simply the historical cost, which is the initial cost, minus the accumulated depreciation minus the impairment losses. That is how you will always calculate it. And carrying value will always be calculated at date of revaluation. So when a company decides they have to revalue the asset, you will calculate the carrying value at date of revaluation, which means that you will account for accumulated depreciation up until that point. All right. Fair value is simply market determined value at revaluation date. And you will compare these two figures. You will compare carrying value with the fair value. In order to calculate revaluation gain or loss, you will always take the fair value and you will deduct the carrying value from the fair value. If the fair value is higher than the carrying value, you have made a gain on revaluation. All right, but if the fair value is less than the carrying value, unfortunately you have made a revaluation loss. So we must remember it's all about comparing the two values and then determining if we have made a gain or if we have made a loss. So what is revaluation gain? A revaluation gain occurs when the fair value of an asset exceeds its carrying value. Under IAS 16, revaluation gains are recognized in other comprehensive income and accumulated in revaluation surplus, which is an equity account. It's a reserve account. To recognize that gain in other comprehensive income. Why not in profit or loss? Usually when we think of gains, we think that it should be recognized in profit or loss. Why do you think it is not recognized in profit or loss? The reason is because this is an unrealized gain. This is a gain that simply exists in your books, and all the unrealized gain is going to sit in your other comprehensive income. So basically you haven't had any kind of cash benefit from this particular gain. So you will take this gain in OCI and this will be accumulated in revaluation surplus. So we open up a reserve account in statement of changes in equity. It's an equity account, but you see that it will also be reflected in the statement of financial position under the equity section. All right, so you will have a balance of that gain sitting in the revaluation surplus as well. So therefore the journal entry would be debiting the asset, because of course we're increasing the value of the asset to its fair value now. So all the debit is going to increase the value of the asset, and because revaluation surplus, OCI and revaluation reserve entry is credit, you will credit the revaluation surplus and then you will credit the revaluation reserve in the equity account. That is what revaluation gain is. But we just now saw that we can also have a revaluation loss. And a revaluation loss when the fair value of an asset is lower than its carrying value. The loss reduces the value of the asset and is recognized in profit or loss as an expense, which is kind of sad for the company. All right, because we know, just now we have seen, once a company adopts the revaluation model, they must be updating the value of the asset on regular basis. It is not a one-time revaluation. So for example, because if I have adopted this method, in the next year, I, for example, make a loss. Unfortunately, I will have to recognize this revaluation loss in my profit or loss. But why? And the reason for this is the prudence concept, which says that you have to recognize the losses immediately, while the gains are only recognized in other comprehensive income until it will be realized. All right. So here you will recognize the loss of the revaluation, which will be debit profit or loss, and credit asset because now we have a reduction in the value of the asset. So we will be crediting the asset to reduce the value. So this is a very basic understanding of revaluation gain and revaluation loss. Now there are some certain things that can also happen within a company. For example, what we define them to be as reversals, a reversal of a valuation gain. It is very common that an asset can be previously revalued upwards. So in the previous year, my asset's fair value was higher than its carrying value, so I had done revaluation upward. But in this year, it is very much possible that the fair value of the asset goes down, and therefore now I have to revalue it downwards. So basically for that same asset, we also had a revalued upwards, and we also had revaluation downwards, which has happened in this period. And therefore, what happens now is what we define as the reversal. Now the reversal is going to happen. It was now revalued upwards in the last year, and now it is revaluing downwards. So it is basically a reversal, that you're bringing the asset down. Now there are steps in order to account for the journal entry, in order to understand the numbers. Now, once, for example, it was revalued upwards, the journal entry at that point, the company that must have passed would have been debit asset to account for increase in the value of the asset, and there must have been a credit to OCI, or the equity account, which is the revaluation reserve. But now if it is going to be revalued downwards, what is the first thing that should come into your mind? You tell me, forget about the journal entries down below. When the asset is going to be revalued downwards on very simple plain basis, you can think that, okay, revaluation downwards means we will be crediting the asset now. And that's a very basic thing. At least let us get something right. The asset will be credited downwards. But there's something else that is also going to happen. Why? Because notice we have a reserve balance sitting in relation to the gain on that same asset. And now we are revaluing it downwards. IAS 16 has a specific treatment for this particular situation. Step number 1, reduce the value of the asset to account for revaluation downwards, which will be revalued, which will be in the SFP account under non-current asset, which we have already done. So what we will do, we will be crediting the asset, which we have already identified. Step number 2, now deduct the loss from the revaluation surplus in OCI or reserve account. So for example, the revaluation downwards in this year has produced a loss of $100. And let's say what you should do now, you will go to the statement of changes in equity and you will see how much was the gain on the reserve account sitting, which I had recorded in the previous period. So for example, that is a $50 gain, which is sitting in my reserve account. What I will do is, I will take this loss, and from this loss, I will take $50 and I will use that $50 to first eat this gain. I will eliminate this from my account. So because we know that revaluation surplus is a credit balance, at this point what I will do is I will debit revaluation reserve account with that same amount of gain that was sitting there. I'm reversing that gain. I'm wiping it out. And what happens? I've used that 50 to eat the reserve balance, and what I will do with remaining 50, there's a still $50 loss remaining. I will take it to the P&L. It's a very simple basic understanding. Just now we have seen that when the loss is going to occur, we will take it to the profit or loss. When the loss on revaluation occurs, we will recognize the loss in the profit or loss. So I will now debit the profit or loss with the remaining $50 and credit asset with a total of $100, because the loss in total is $100, which you will use to reduce the overall value of the asset. All right, this is how it happens. So for the loss, first it will eat the gain on that asset. After it eats all the gain, the remaining will go to the profit or loss. All right, this will be further cleared when you will do the question, so don't worry right now, just get a basic idea. If at anything over here you do not understand, please put a comment down below and I will try my best to reply you in detail. But just get a basic idea of what happens in the reversal of revaluation gain. All right, moving on, we have a reversal of revaluation loss, and it is very common that an entity can have a previously written down asset due to a revaluation loss, and in this period we have a revaluation upwards. What will happen now? So very simple, the steps are almost similar, which says that you will increase the value of the asset for revaluation upwards. An asset, we know it's already recorded, always recorded in statement of financial position. So first you will increase the value of the asset. Why? Because in this period we are revaluing it upwards. So for this particular example, consider that the gain in total we have made is $500. The gain, by comparing the carrying value with the fair value, we have a revaluation gain in this period of $500. So you will debit the asset by $500 by updating the value of that particular asset. But we are not forgetting, remember, do not forget that we had also revalued the asset downwards and we had a revaluation loss. When in the previous period the revaluation loss had incurred, at that point I had passed this journal entry. Debit profit or loss, I had recognized a loss and credit the asset to bring the value of the asset down. Now assume that the loss in the previous period that I had incurred was $200 and I had reduced the value of the asset by $200. All right. Now IAS 16 says that if you had a revaluation loss in the previous period, which I know is $200, what it will say is you will take the portion of the gain which you have recognized in this period, and the gain is $500, and you will recognize the gain in profit or loss to the extent of the previous loss. What is my previous loss? $200. Now it is saying you have a gain of $500, and from this gain you will take away $200 and you will give it to profit or loss to the extent of the previous loss, which was $200. I will now give that to P&L, recognize that as income in this particular period. So it says you will credit the P&L to the extent of the previous loss. First I was debiting P&L, but now I will credit P&L. I will reverse. This is what we call as reversal. I will reverse it. Now after I've given $200 to the P&L to the extent of the previous loss which I had recognized in the previous period, the remaining gain is $300. Where will it go? Very simple, because it's revaluation upwards. We all know in revaluation upwards the gain is always recognized in other comprehensive income. You will give it to other comprehensive income and also recognize that in the reserve account. So therefore I will credit the OCI or the reserve account by the remaining $300. And notice how the journal entries are balanced. The debits are equal to the credits. Do you understand? I hope you understand this. Just get an idea. It's very simple. Just get your head around the basic concept in the revaluation and you will then understand how it works. But again, we will do the questions and you will all be cleared, so don't worry. All right, just get a basic idea. Now let's talk about the concept of excess depreciation. Now it says that when an asset is going to be revalued upwards, its depreciation is also going to increase. To better understand this, think about it. You had a carrying value of the asset at $1,000. And because you have adopted a fair value policy of revaluation for your assets, when you do the revaluation, the fair value of the asset was $3,000. All right. Now, when you update the value of your asset from $1,000 to $3,000, you make a gain of $2,000, right? Now, subsequently, remember that once you update the value of the asset, subsequently, you will carry the asset at $3,000. And we all know that depreciation is going to get charged. So what happens is now the depreciation on that asset is going to be charged at $3,000, and automatically it increases my depreciation charge. How unfortunate. Think about it. I'm making a gain. Yes, I'm making a gain. But on the other hand, I'm also having a higher depreciation charge, which is unfortunate. Because what is happening, previously the depreciation was on $1,000, and now I have a depreciation charge on $3,000. So this is known as excess depreciation, which is simply the difference between depreciation based on the revalued amount and depreciation based on the historical cost. To comply with the matching principle, what happens now, what IAS 16 tells you, that the companies can transfer this excess depreciation from the revaluation surplus to retained earnings, to ensuring that the revaluation surplus is utilized over the passage of time. So what happens is you will calculate the excess depreciation, which is simply the depreciation difference between the value at $3,000 and the asset value at $1,000. So you will calculate the excess depreciation, and number two, with that amount you will make a reserve transfer, and the reserve transfer will happen from the revaluation surplus to the retained earnings. So you will debit revaluation surplus with the amount of excess depreciation, and you will credit retained earnings with that amount of excess depreciation. So basically what happens is, even though you're charging excess depreciation, IAS 16 tells you that what you can do is you can make a transfer to the retained earnings with the same amount. So this transfer does not affect the total equity, but simply shifts the amount from revaluation surplus to retained earnings, allowing from its gradual realization. So you're basically realizing that gain, because that gain is sitting in OCI, right? So as the asset is now going to be utilized with that high amount, all right, high revalued amount, as the asset is utilized at the end of the reporting period, you will make the transfer from revaluation surplus to retained earnings to basically reflect the utilization of the asset. So once we will do the question, we will also revise it. But I hope this session was clear to you. This is all that you should be knowing about the revaluation model and the cost model. So as a summary, this is how it should look like. IAS 16 revaluation, you have a revaluation gain and you have a revaluation loss. And then once you have this, you should ask yourself the question, if you have a revaluation gain, you ask whether we had a revaluation loss in the previous years. No, if there was no revaluation loss, you will simply debit non-current asset and credit OCI or revaluation reserve. Why? Because we have a revaluation gain happening. All right. But if we had any revaluation loss happening in the previous years, you will pass the journal entry to credit the profit or loss with the amount of the loss which you incurred in the previous period, and then as normal you will credit the revaluation reserve and you will debit the non-current asset. Very similar, if you had a revaluation loss, you will ask yourself if we had a revaluation gain in previous years. If the answer is no, then you will simply debit profit or loss and credit the non-current asset to reflect the current revaluation loss. But if you had a revaluation gain, what you will do is you will reverse that gain which you had made by debiting the revaluation reserve, and then you will take the remaining loss and then you will debit the profit or loss, and then you will credit the non-current asset to reflect the revaluation downwards. So if you want to take a screenshot of this flow chart, you can do this. Let me just clean this up, and will be providing you a great summary to help you understand the rules of the revaluation. I hope this session was helpful to you. In the next session, we'll be discussing the questions that are pertaining to the standard, and we'll be discussing exam standard questions. So any confusion you will have, hopefully will be cleared in the next session. If there's anything, please let me know in the comment box below. And if you liked this video and you found it helpful, make sure to subscribe my channel and please share it with your friends who can benefit from this knowledge. I'll see you in the next video. Take care and goodbye.